Welcome to the latest Evershed Sutherland Legal Insights podcast.
Hello, and welcome to Hot Takes, the companion podcast to our series of interviews with leaders and luminaries from the financial services industry, which explores trends and opportunities in global financial markets in 2025. I'm joined today by my colleagues Reid and Rhys McWhirter, who are both partners in our technology and financial services practice. Rachel joins me here in the US, and Rhys is joining us from Hong Kong today. So Rachel, Rhys, welcome. Thank you both for being here. We've just listened to our colleague Matthew Allen in conversation with Azmina Kashani, who's the Chief Legal Officer at Zodia Custody, on all things digital assets. Rhys, the thread through the whole conversation that they had is growth, expectations for it, how the regulatory frameworks can either help or hinder it, and how changing consumer interests can drive it. Azmina comments that the digital assets market is really only moving in one way. What are your thoughts on future growth and development of the digital asset market?
Thanks, Sierra, and good to join you and Rachel on the podcast. The short answer here is that we're seeing a tidal wave of regulation coming globally, both in the US, which I know Rachel will touch upon, in the UK, Europe, and sort of more pertinent where I'm here, based in Asia, which is then bringing with it institutional interest as well as investor interest. And I think it's important when you're looking at the landscape of digital assets, there's really sort of three multidimensional factors at play here. You've got holders and investors as one element, you've got trading venues, and then you've got the geographic activity. So if we look at holders and investors, I think what we're seeing now is announcements of regulatory certainty, which is effectively bringing with it institutional money. Because let's not sort of kid ourselves on the fact that as a large FS institutional player, you're going to get involved in this activity where there is regulatory certainty. You are subject to compliance with FS regulations all around the world. They are complex, they are multidimensional, and so having a robust and clear regulatory framework gives you confidence to bring the institutional money into the regulated activity. But more importantly, it also gives the investor confidence to deal with the institutional in relation to this activity. Because I think we also need to look at the type of assets that this regulation is going to regulate. And I mean, we take Bitcoin as an example, where we have effectively the top 2% of all wallets are estimated to hold 93 or 95% of total supply. We need to bring this sort of regulatory framework and regulatory burden into the mix to give investors and institutional players the certainty to do business. We then go into trading venues, whether it's going to be a centralized finance model or a DeFi model. Again, regulatory certainty is going to help sort of flesh out the nuances there. And then we sort of get to the geographic activity, which to me is the interesting part, is we're seeing markets emerge now as effectively digital asset friendly. Here in Asia, and I'll let Rachel comment on the position in the US, but here in Asia, we've had sort of the two big market players, Hong Kong and Singapore. Singapore is a very early leader under the Payment Services Act, but has effectively hit the brakes recently. That's allowed Hong Kong, sort of my home jurisdiction, which was, let's say, rather reticent in sort of 2017, 18, and 19, to actually now come to the market with a regulatory framework. We had consensus in Hong Kong just last week, where the SFC outlined its roadmap for resilient virtual asset reform and ecosystem. And so there's a number of exciting things on the cards in Hong Kong. We also had the announcement by one of the large global banks in Hong Kong, Standard Chartered, of its joint venture with Animoca Brands and HKT on being one of the first stablecoin issuers in Hong Kong, albeit that's going to be regulated by the Monetary Authority. So there's no surprise, I guess, Sierra, that where you're seeing profound momentum from a regulatory perspective with certainty, you're seeing the investors and, more importantly, the institutional money come into play.
Thanks, Rhys. That's great. And you really hit on some of the points that Azmina was making as well about the sort of sense of certainty that strong regulatory frameworks can create. Rachel, I'll pick up on that with you a little bit. So on the point of rules and regulation, Asmina shared her perspective on the need for a balance between hard rules and principles-based frameworks. And, as I listened to her talk about that, I was thinking about a lot about the work that you've done with a lot of our clients, especially in the AI space. And I wonder if you could just reflect on some of the best practices that you've observed across emerging tech more broadly, in terms of this approach in terms of adopting a balanced approach to regulation.
Of course. Thank you, Sarah. And it's a pleasure to be here with you and Rhys today. I think on the regulatory front, and picking up on Rhys's comment about certainty, in the US in particular, we are clearly in a time of great uncertainty. And if we've learned nothing else about regulatory frameworks in the US, it's that they can shift often dramatically and in a very short period of time. So we went from a much more conservative, regulatory environment on both digital assets as well as emerging technologies such as artificial intelligence to one that's much more pro-innovation and sort of light on regulatory and restrictive rules and prescriptive regulations. So I think Asmina is spot on that we need to find a balance. But the question is, what are companies to do in this absence of certainty in the regulatory framework? And that's where we often look to these risk management frameworks or sort of risk-based principles. And they're fairly general. They can apply across all different kinds of products and technology. And it's really things like transparency, notice, explainability, helping consumers really understand what the risks are, what the company's done to mitigate them, and then what their choices are as far as investing in the technology or not. When we're working with clients, there is really a balance between making sure that they're preparing for a changing and shifting regulatory environment, but at the same time not stifling innovation, and that they're able to fulfill kind of what they're viewing as the market demand or the consumer demand in different spaces. So a lot of times it's just as simple as kind of sound product development practices as you're working through your plans, making sure you have robust documentation, making sure you're, again, sort of considering the risks, documenting the risks, and then documenting any mitigation strategies. And that should get companies in a position where if we do see a shift down the road, they're able to adjust and react to it without a dramatic impact to the marketability of the product or the technology. Because what we've seen historically is that regulation can be either proactive. So what we saw under the Biden administration putting out this executive order on AI is that they were really trying to look ahead, right, and see what the future was going to bring and regulate with that. What we're seeing with the Trump administration is almost the way I interpret it is let's get rid of the majority of regulations. And then if something goes horribly wrong, right, we can always bring them back in. If we see something happening in the marketplace that we don't like, we can adjust and impose regulations. And so that makes it, again, companies shouldn't anticipate that we'll be in this sort of light regulatory framework forever. Particularly in the US, again, it's not just the risk of the federal government coming back with new regulations. We will likely see state attorneys general and state governments like New York and California step up with sort of broad sweeping regulations if they view a gap in the regulatory framework. And then there's always the class action risk, right? Almost every state has a very broad general unfair and deceptive trade acts and practices law that can be used widely for enforcement and in most states for class action litigation. We're also seeing an uptick in class action litigation in the UK and in other parts of the world where it historically hasn't been as common in the US. So what we know is that, right, in the absence of prescriptive or robust regulations at the federal level, there will be ways to close those gaps to protect consumers. So companies should definitely prepare for that.
Yeah, that's such a great point, Rachel. And I mean, something, a nuance of the US regulatory landscape, right? We often see states stepping in to fill perceived gaps. And I think that's something important for our for companies who are maybe based in other parts of the world, but operating here, to keep in mind that it's not just federal regulation that they're subject to. So I have one more question for the two of you, touching on the last point that Matthew and Azmina covered, which was really about this increasing desire for exposure. So Azmina gives the example of pension funds who, one could argue are among the more conservative of institutional investors, making a move towards digital assets, which I think is somewhat telling about the market more broadly. So looking across the landscape of emerging tech, digital assets, AI, quantum, et cetera, what's your perspective on institutions' appetite for innovation, and how do you think consumer expectations are shaping that? And Rhys, I'll come to you first.
Thanks, Sarah. Well, I guess to me, the driving force here is really the consumer expectation from a service delivery perspective, from a product and service perspective. And so consumers are going to be driving a lot of the pressure in requiring their financial service providers to come to the table with novel solutions, novel products and services. I think it's no surprise that we've seen the pension funds get into this space. Yes, they're slow moving, but I can't help but think that the regulatory framework, yes, still disaggregated at a global level, is seeking uniformity in sort of some of the key financial hubs around the world. And that's probably giving them some certainty to get into this space. I think as well on the investor side and the consumer side, I should say, is that the regulatory framework looks to address, I guess, one of the key issues with this particular asset class, and that is effectively unfair, sort of disproportionate and misbalanced liquidity pools around the world under some of these asset classes, as well as, let's just say, the speculative trading of certain assets. And so as these regulatory frameworks come in and provide sort of clearer guardrails for effectively how existing financial products can be repackaged, albeit with new tech, with new smart contracts, that is going to create more comfort on the institutional side to bring these products to bear. Although we've seen some movement, and I'll turn to Rachel to get her thoughts shortly, although we've seen some movement over the past 6 to 12 months, I still think we are probably some ways away, say 12 to 18 months, before we're going to see significant institutional activity globally in these asset classes, merely because we do not have a uniform regulatory approach. And at the moment, I think regulators around the world are open and are sort of eyes open and minded to the fact that some of these institutional players are sort of moving from jurisdiction to jurisdiction, which ultimately undermines sort of the cross-market portability of some of these products.
Thanks, Rhys. Rachel, anything to add?
Yeah, I agree 100%, Rhys, that I think we saw a little bit of a sort of quicker movement in the appetite here. And I think a lot of that was sort of in reaction to the rise of companies like NVIDIA, right, and the chips and sort of the backbone of some of these emerging technologies and digital assets. And there was a little bit of buyer's remorse or regret that, right, we hadn't kind of jumped in on that earlier. But now what we're seeing in the market is sort of AI technologies, digital assets, crypto companies are really popping up kind of overnight. And I think consumers are smart enough to know that not every company is going to make it. Sort of when we had the dot-com boom, right? There will be winners and losers at the end of it. There should be a fair amount of market consolidation in certain areas. So there's a little bit of yes, we want to move towards this. We see that some of these emerging technologies, quantum, AI, really are going to be the future and the backbone of even institutions like financial services companies, right? Everybody is going to have to invest in technology in order to be successful. But when it comes to the market and the regulatory framework, given the level of uncertainty, I agree with Rhys that it'll be a little bit slower to adapt. But we'll see, I think continual upward movement until we sort of hit a point where either there's much greater market certainty or much greater regulatory certainty around some of these. Azmina raised an interesting example with the pension fund. So for example, what we saw in the US, whereas over the past 5 to 7 years, we finally saw a move in some of these investors towards ESG and sort of alternative types of investments. And then with the change in administration in the US, that was sort of immediately took a big backward step there. with this encouragement to sort of look at cryptocurrency and artificial intelligence and emerging technologies. So definitely the regulatory landscape can sort of influence that, but ultimately, to Rhys's point, it's going to be down to consumerism, consumer demand, and sort of how the market reacts to all of these developments.
Maybe one further comment, Sierra. I appreciate we're probably short on time, but I think Rachel makes a really, really interesting point that I just want to amplify a little bit. And that is, if we look at consumers are alive to the entities that are sort of operating overnight in this space, in sort of, let's say, emerging tech more generally, digital assets, AI, etc. And we've had some very recent market examples of how perhaps the bubble has been burst in some of those sectors with the arrival of new players with different solutions and different configurations. But to me, if we look at sort of digital assets, it's not that long ago that we had FTX, and many consumers are still reeling in the aftermath of that. However, it's interesting, this entire conversation that the three of us are having now is in the aftermath of that, but not in the aftermath that the crypto market is dead. And I think to me that says a lot about the technology itself, is that yes, there are going to be bad actors in this space, but there's no denying the power of that technology. That, let's just say, that technology that has the audit records, the transparency, effectively to sort of investigate the issues that come up that, let's face it, did not exist in other sort of global financial crime matters that happened in decades gone past. So it's the fact that I actually think the technology has sort of been battle tested, if you will, through the FTX scenario, that yes, there are bad actors, but we're still talking about it, and we're still talking about it in a sort of more, I guess, a more growth mindset.
I think that's exactly right, Rhys, and I think that's a good spot to end it. And as Mina made that same point, right? She said, yes, there will be things like FTX, which will cause, a blip or a bit of, angst, but this market is only moving in one direction, which I think is exactly what you're saying. Well, the two of you are brilliant. I had a great time chatting with you. Thank you both for being here today. And of course, our thanks to Matthew and Azmina for giving us great food for thought and discussion. Tune in all year long for more hot takes.